Hi, this is Mike Maloney, and I've got something brand new to show you. Now, much of the material that you're going to see in here you have seen before, but stick around because there's something at the end of this video that is very important that you're going to want to see. But several months ago, I did a webinar called Early Warning System. And basically, what I was trying to create was something that was early, and it was a warning. That there's something wrong out in the markets. And what you see here, this is the value of the stock market. This is the Wilshire 5000 Total Market Full Capitalization Index. So that means that this is it's the total number of shares out there in the vast majority of the stock market. It's not points like the S&P or the Dow. And what you see here is that it's been having some problems lately. And we've seen that, this year, all of the gains for the entire year have pretty much been wiped out. And the stock market made a peak and then did a crash, and it made another peak and did a crash. So that's the stock market. Back in 2015, I came up with something I call the financialization of government. This is the growth of base currency. So the currency that the Federal Reserve and the Treasury create. Whenever the Federal Reserve buys something, it creates currency that didn't exist before. And when they buy that thing, that's how they get it into circulation. It used to always be U.S. bonds, Treasury bonds. But then they added, during the financial crisis, mortgage-backed securities and any other piece of trash they wanted to get off of a bank's balance sheet. And so they just buy these things from the banks and they shove a bunch of cash onto the balance sheets. And that's supposed to stimulate the economy by lowering interest rates and making the banks look safe. But you've got QE1, and then you've got quantitative easing 2 and quantitative easing 3, the three different programs they had for the expansion of the currency supply. Now, you've seen this before, but I do need to go through it again to get the meaning of the end of this video. There's something where all of this sort of adds up. But so here is the growth of the currency supply and the growth of the stock market. And the correlation is absolutely astounding. There, like I've said many times before, there is just no chance that this is an accident. The expansion of the currency supply, remember, when the Fed creates the currency, they take an asset off of the bank's balance sheet and they shove cash on. Now, some of those banks are investment banks like Goldman Sachs. These are brokerage houses. So you've got Goldman Sachs and Merrill Lynch getting all this cash that the Fed has created, and of course it lifts the stock market. But you'll notice we've had these pullbacks, and they coincide with the reduction of the Fed's balance sheet. They're trying to reduce their balance sheet, which means when they reduce their balance sheet, they do that. Their balance sheet has assets, which are mortgage-backed securities and treasuries and things like that. And then it's got the liability side. And the liability side is the cash they created. And so to reduce the liability, when they want to reduce the number of treasuries that they own, they sell the treasuries back to the banks, and they take the cash that they pull off the bank's balance sheets and they destroy it. It's gone. And so that's what you're seeing here with this little contraction. Now, I'm going to revisit the expansion of the stock market again, and that it's gone ballistic. I mean, this is crazy. It's in runaway mode, and remind you of the two little pullbacks here. And then I'm going to show you tax receipts, federal government current tax receipts. And notice how in this century, and I've shown this before, I call it the financialization of government. There are these huge drops in tax receipts that happened. It was back in 2014 or 15 that I was looking through a bunch of charts on the Fed, and I went to tax receipts and went, oh my gosh, that looks like the stock market. And so I overlaid the two, and there it is. It follows the stock market. And the interesting thing, even the crash of '87 that was huge, the tax revenues didn't correlate. There was no correlation whatsoever between the stock market and tax revenues until the year 2000 with the NASDAQ crash and then the global financial crisis. And now the correlation is astounding. And that means that the stock market has to do well for the government to have enough revenues. So I dubbed this the financialization of government, because what has to happen from now on, since the year 2000, is if the stock market does poorly, the Federal Reserve has to create the currency, a quantity of currency required, and it doesn't matter what that quantity is. They have to create that quantity to lift the stock markets up again to get the revenues, because when there's a crisis, when there's a recession and the economy does a pullback, tax revenues fall now, and that means the real deficits, I say real deficits, not the budget deficit. I say the real deficits because there's a big difference. I'll show you that in my next video. But the deficit expands as tax revenues contract because they never plan on a recession ever happening. They just project out whatever the current rate of tax revenue growth is, they think that's just going to happen into infinity. And so when a recession happens, the stock market falls, there's less capital gains taxes that come in, and suddenly the deficits go enormous. Plus, whenever there's a crash, they want to stimulate the economy. And they do that with low interest rates and currency creation, but they also do it with a whole bunch of programs that they come out that even increase the deficit more. And so now I'm going to take all three of these charts, and you haven't seen this before, and I may have put it in my early warning system. So this is sort of an update to early warning. But here's all three of the charts and how they correlate. Green line, the creation of base currency and lifting the stock market. And what you see here is that QE1 and QE2 went to both Wall Street and Main Street because tax revenues increased. But QE3 was just a gift to Wall Street. It all went to some of the richest people on the planet, because if it had gone to Main Street, tax revenue, if business increases, tax revenues increase. But again, we have these drops in tax revenues that correspond to the drop in the contraction of the Fed's balance sheet. And lastly, one thing I want to show you here that you haven't seen before. While I was on the Fed's website just yesterday putting all these things together, maybe it was the day before, I started looking at the different tax aggregates. And so this is tax receipts from corporate income. So it's only corporations that they're measuring here, businesses. And the astounding thing that stuck out at me was, this goes back to 1930. So 1929 is back up here somewhere. And what you see is that it started falling, and we had a really severe recession, the kickoff to the Great Depression. And then they rise, and then it starts falling, and we have what's called the Roosevelt recession in 1937-38. And then it rises and rises and rises as businesses do better and everything. And as soon as businesses start to slow down and there's less tax revenues, another recession. And then it repeats, it rises and contracts, and we have another recession. It rises, it contracts. This is sort of a little fake out here because it expanded just a little in that 1 year. This is in the 50s. But then it rolled over again and we had a recession. It rises and rolls over, we have a recession. It rises, rolls over, we have a recession. It rises, we have another fake out, small one, but it rose more. And then when it contracted, we had a recession. Rise, contractions, we have a recession. Rise, we have a contraction. And this is the famous, it's called the double dip recession of the Reagan era. So one recession and another recession. And then it rises. This is a flat spot. I'm not really going to call it a contraction. But then when it rolled over, contraction, a recession. This one, it contracted a tiny bit. I don't know whether to count it or not as a fake out. But then when it peaked and started to contract, we had a recession. Then it rises and it starts contracting, and we have the global financial crisis of 2008. Now it has risen and it's started to contract. And what we have here are 14 recessions. And if you include all of the little contractions, there's 17 contractions. So 14 out of 17 times, this was an indicator that we were going into a recession or we're already in a recession. And remember, a recession is a trailing indicator. They collect data, and then the data is posted a month or two later. And they have to have data that says we've been in an economic contraction for 2 months in a row before it gets officially dubbed a recession. And the data comes in a month or two late. So you're talking about 3, 4, 5 months before we know that a recession started. So whenever they declare we're in a recession, that means it started at least 4 months ago. And so we might be in a recession now. I don't know. But this is one of the most reliable indicators that I have ever come across just based on its history. Thank you very much for listening. I'm Mike Maloney. If you liked this, please give it a thumbs up, share it, subscribe to our YouTube channel. Click that little bell as a reminder so that you get reminders whenever there's a new video. And we'll see you next time. Thanks for watching.